Good afternoon, everybody, and a very warm welcome to the latest event in our series of professional advisors working lunches. Today, we're partnering with Schroders, and I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off, and we'll be most grateful if you can keep them that way. It will ensure there's no background noise, so all of the speakers in today's session can be heard clearly and crisply. I should also inform you this session is being recorded, and we'll send you a link of the recording by tomorrow. Of course, do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. Right, that's most of the housekeeping out of the way. Let's dig into the content. The events of the past 2 years have seen a shift in the way advisors are doing business. Digital communication, a raft of offers from private equity firms, and a more enlightened next generation of investors have created exciting opportunities for the profession. I'm delighted to be joined today by two key executives from Schroders, Intermediary Solutions Director Gillian Hepburn and CIO Alex Funk, as they present the results of their latest advisor survey and discuss what it means for the future of financial advice. And to keep the conversation balanced, Gillian and Alex will be joined by our regular advisor expert, Philip Martin, Managing Director of the advisor firm Unique Financial Planning. Of course, throughout the session, do feel free to put any and all of your questions to our guests using the chat function, which you will find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, and that way only I can see the question you've put across. So just before I hand over to Gillian, let me quickly run you through our learning objectives for today's session. So after the session today, you should be able to understand views on the investment market in November 2021 and how they've now changed, discuss the importance of ESG factors when selecting funds, clients' views on sustainable investing, and some of the challenges with the proposed legislation. And finally, assess your business in the context of wealth transfer, the opportunities, difficulties, and potential impact on succession planning. So that's the CII and the CPD covered. Let's hear from Gillian Hepburn from Schroders. Good afternoon, Gillian.
Hi, good afternoon, Tom, and to everybody else that's listening this afternoon. Alex and I are going to cover some of the feedback from the UK Financial Advisor Survey that we undertook at the end of last year, and also have a conversation with Philip about what does this mean for advisors and how does this also resonate now, given that we're already part of the way through 2022. So the areas that we're going to cover are markets and outlook, sustainable investing, some stuff around business challenges, wealth transfer, and as Tom said, a Q&A at the end where I'll hand back over to him. Just a little background about the advisor survey. We do this on an annual basis, and we do a little pulse survey about half year. But the annual survey is our main survey. We started many years ago, as you can see here. We conduct it online, and last year at the end of November, it was completed by over 200 advisors, and that's actually one of the largest responses that we've had over the many years to the survey. So it was really clear that advisors wanted to tell us about what was happening, what their thoughts were, and a little bit about the challenges within their business. So we'll look at that in some detail. Now, we did mention that we look at the investment position, and back in November, we asked advisors what they thought was going to happen in markets and what the sentiment was. Now, clearly at that point back in November, nobody could have anticipated the dreadful events that we've seen over the last few weeks. So as a result, we decided that maybe none of us had a crystal ball back in November, and rather looking at what we thought might happen, where I think we probably all called it wrong. We would hand over to Alex Funk, who's Chief Investment Officer here at Schroders Investment Solutions, and he'll actually just focus on what we think is happening in markets at the moment. So Alex, I'm just going to hand over to you first of all, just to give us a bit of a run through about what's actually happening in markets and some of our views.
Yeah, thanks, Gillian. Good to be joined this afternoon. So I think where we are at this point is that global growth, coming out of 2021, we expected that to be sustained going into 2022. We've then seen Russia invade Ukraine, and that's had a knock-on effect, specifically through the commodities channel, which we'll unpack a little bit going forward. But what that effectively means is that we're going to expect a slowdown on growth. So we've sort of revised our growth numbers on a global GDP basis downward from where we were, and then normalizing into the 3% as we move into 2023. Now, we should still note that, a 3% growth rate annualized from 2023 is not a bad growth rate. It's less than where we predicted we would be pre-invasion and pre-war, but I think there is still sustained growth going forward. I suppose the problem that we've got is the inflationary impacts of this. And so the war has created a knock-on effect in the commodities channel, which we can talk a little bit about. But here you can see a sharp upward trajectory and our expected inflation outcomes. So we've revised up the expected inflation for 2022 to 4.7%, which is higher than what we had that in a pre-war scenario. And then that's starting to normalize as we go into 2023. So I suppose with that as a backdrop on our baseline, if we move on, we could talk about some of the scenarios I think that we could experience. And so I'll really focus on the top left-hand corner. So I think there's probably two issues here. We had inflationary pressures pre-war that was stemmed, off the back of COVID. We had supply chain bottlenecks and all the reasons that we've discussed over the last sort of 18 months. And then we have this other scenario where we say Russian aggression continues. And why is that inflationary? And so just a quick reminder of what we mean when we say stagflation. Stagflation means periods of slower growth and higher inflation. And so those two aspects that I've described remain quite inflationary. And so Russian aggression continues is the other scenario that can both impact growth and inflation. And the reason for that is the channel through of inflation and commodities. And on the right-hand side, you can effectively see the share of exports from both Russia and Ukraine on sort of key commodities, not only natural gas and oil, but a range of different commodities, cereals, fertilizers, nickel, and we can start seeing how this impacts a range of manufacturing outputs and effectively inflation as well. So I think a lot of the headlines is talking about the gas crisis, the energy crisis, but there is food crisis that is on the rise here as well. I won't spend too much time on sort of deflationary, productivity boost, reflationary, because I think most of the risk probably lies in the stagflationary camp where we are standing today. So if we go onto the next slide, we could say, well, what is this impact, right? And so, I want to demonstrate that the largest impact to global growth in GDP is really through this commodities channel. So yes, there is a negative impact from a Russian demand on the global economy, but that is small in comparison to what we think is going to happen from a commodities channel perspective. Naturally, Europe being closer to Russia and the borders will be, more severely impacted, and the reliance on gas supply from Russia. And so we can see, obviously, Europe is a large part of some of the OECD members, but this has a negative net effect, I think, across the world is really the takeaway here. And then you can see how that translates into an increased inflation. So this is analysis done by the OECD to say, well, what is the impacts of the conflict? What does this imply from a substantial and ongoing hit to one, global growth, and second, to inflation? And I think from an inflation perspective, the issue we have is that we were moving into an inflationary regime before this happened. And so this is compounding effects of what we've seen. And so there you can see the inflation effect in Europe being the largest. I mean, key economies such as Germany is heavily reliant on gas supply from Russia. And so there is this risk that sort of taps get turned off. We're already seeing a change in currency from euros to ruble, which is creating some nervousness around how the Germans will access this going forward. But again, this then has a knock-on effect because of manufacturing inputs, service providing across that of world economies as well. And on the next slide, the obvious question is really, well, what do we do about it? And I think you have some really interesting analysis to say, well, what would be the impact and how can we offset that with fiscal support, so targeted relief, similar to a grander scale of what we're seeing in the UK from energy support as well. And so there you can see there is a targeted fiscal approach that can lessen the shock, and specifically in Europe, sort of from closer to 1.5% to closer to the 1% number. And that's the gray bar on the top. You can see is what is the cumulative effect of that fiscal response need to be in order to reduce some of the negative impact that we can expect. Now, the obvious question should be, well, Alex, if we add more fiscal, which is what we did post-COVID, are we not creating more inflation problems in the same way that we had before? And so the analysis here shows that, the inflation shock that is in play because of the commodity channels through Russia is effectively the orange bar. If we add fiscal response to alleviate the consumer, it's the gray bar is the marginal difference of inflation that will add to the problem. So you can see that the trade-offs make sense from a targeted fiscal response in order to alleviate some of the consumers and some of the economies, and therefore the net impact on inflation is quite small. So if we move on, Gillian, onto the next slide, I think we often forget that there are large parts of Europe that's heavily reliant on natural gas. And so what we've charted here is just to give you an idea of how grand the problem could be if there's a reduction in supply. And there you can see key economies such as, sort of Germany, Norway, Poland, Hungary, all affected by this. And again, it's more European problem. But this is effectively leading into sustained inflation across the world. And so here we can see that even in the US, inflation is now becoming more broad-based, right? So it is more across regions or components of CPI rather than just this transitory bucket that we've been talking about before. So moving on, the big question really comes around, well, yes, we've spoken about natural gas, we've spoken about oil, but what's the other impacts here? And so something that's probably not talked about quite a lot is food inflation. And so as we've discussed, there is a lot of key commodities coming out of Russia, Ukraine. And here we can see that emerging markets will be greatly affected when it comes to that food price inflation due to the increased cost of potash, wheat, etc. And here you can see that the percentage that food actually makes up of the CPI basket in some of these emerging economies. In India, over 50% of CPI is actually generated. So the inflation effect is generated from food inflation. And here we can already see that turn up in food inflation, specifically in emerging markets, are starting to move in that way. And so that is another negative impact that we need to start thinking about beyond our typical sort of energy crisis conversations we're having. So just moving on, I think that probably gives you a good pivot into talk about some of the sustainability aspects when it comes to investing as well.
Thanks very much for that update, Alex. I think hopefully it's been helpful for people listening in, and we will move on to the rest of the actual advisor survey in a minute or two. But Philip, I'd like to just bring you into this conversation. You're at the front line with clients on this stuff. How much time are you spending with clients in terms of communication, and what are some of the challenges for you and clients here?
Well, I don't suppose this crisis is any different than any other in terms of the way that we're approaching it. So, funny, I was asked to comment on another advisor survey earlier on today that suggested that nearly 3/4 of advisor clients were changing their risk profiles and their attitudes to what they're trying to achieve in light of what's going on in Ukraine with Russia. And I have to say, we're not seeing that. And I think that's probably to do with the fact that the advice that we're giving is set up quite deliberately for the medium to long term. Expectations around world events that will and will not happen from time to time, and the volatility ensuing from it, and therefore come out in those conversations. However, we have communicated with clients about the emerging situation. The difficulty is always, the investment industry is very good at producing material, and I could spend my entire day producing material out about what happened yesterday. But by the time I've checked it, made sure it's compliant and put it out, what happened yesterday has just been reversed. So getting a coherent communication strategy is far, far harder. So we've been much more judicious, made sure that we knew that clients knew we were here if they wanted to talk, if all they were looking for was reassurance, and tried to get some of the big messages out. But we would be communicating no more than once every maximum 2 weeks on this sort of stuff. But that's different advisory firms will do it in different ways. I accept that.
Sure, and I think one of the things we talked about when we were having a bit of a chat before this was, this is an area where we can absolutely demonstrate, I think, the value of ongoing advice and paying for ongoing advice, which has felt under pressure at times, particularly with some of the stats coming out about people being put into ongoing charging structures that are not necessarily appropriate. And I think for me, people that are in that kind of an advice proposition, it does mean that you are in front of them all the time, based on when you think we need to communicate to them, rather than the reverse. Would you say that's certainly the case, Philip?
True. I mean, I shared your story of a client communication that we received at the weekend. She's 5, 6, 7 years out from retirement. It's not massively imminent, and she understands that there will be volatility in the market from time to time. But she was asking, could somebody give me a call? And in her own words, quite clearly, because all she wanted was some reassurance. I think that's a perfect example of how an ongoing relationship is adding some value. And this constant debate of trying to match physical activity involved in physically making recommendations really misses the fundamental point of the relationship that advisors have with clients. I think it's very misguided.
Yeah, I couldn't agree more. And clearly we can pick up some questions on this or cover it again later on in the session. So if I just move on to just some of the other areas that the advisor survey covers, and we'll look at what the advisors were telling us at the end of last year. So first of all, in terms of sustainable investing, I think one of the key changes that we've seen over the last 2 years is the number of advisors that are now considering ESG factors in their fund selection process. And I always talk about Alex does the numbers in our business and I do everything else, but double of 43% of advisors considering ESG in their fund selection process, moving to 80, feels like a significant shift for me. And that's certainly something that we're seeing, particularly in the engagement that we're having with advisors. So clearly some changes going on here. And this slide, the key point here is that we're still seeing an increase from clients asking for sustainable investing. And that was particularly over the last 12 months. We also asked, interestingly, because this was the survey was at the time of COP26, we asked whether or not we believed that COP26 would further increase client demand for sustainable investing. Now, at that point in time, as the slide shows, 64% of advisors believed that would happen, but that's maybe something that we want to follow up on a future survey. But it was certainly front and centre for clients at the point where we undertook the survey. And maybe it relates to this next slide. And really what this is showing, if you look at the 3 bars on each side, the first column is E, second S, and then the G. And we always ask about the interplay and the balancing of these. And what we're seeing now is that whilst the environmental factors are really important to clients, there's now much more of an appreciation of the social and governance factors and the impact that they could have on a client's investments. So I think what's interesting for us is whilst the environmental piece was clearly is clearly very important, particularly around the time of COP26, we're seeing much more understanding, I think, of, if I could call it, the interplay of the different factors when considering an investment. So that was just an important change that we'd spotted. And then we always ask about advisor confidence in terms of talking to clients about sustainability, because one of the things we want to do is make sure that our company can work with advisors where they've got some challenges around this to help in terms of, education. And whilst we saw a shift in advisors feeling that they were very confident at that right-hand side, if we add up the numbers, it's about 51% of advisors said that they still had some challenges. Their level of confidence was fair to midline, I think we would call it. And possibly that's as a result of just this ongoing changes or potential changes, particularly this year, in terms of some of the regulations. So things like sustainability preferences and some of the labelling. Philip, how do these resonate with you in terms of sustainability and working with your clients?
Well, we've gone about this. I think there are obviously a number of ways that you can tackle what's available in this space for clients. You can either have, access to individual funds that you want to, match up portfolios for individual requirements to. We've gone about it a slightly different way. It started to embed it in the underlying funds that would make up our core portfolios in any event. So in other words, people are being exposed to it, whether they've specifically asked for it or not. So it's not more of a sort of intel inside approach. Yeah. I think it is quite interesting about the interplay between E, S and G, actually, isn't it? It's always felt to me as though E was the bit that everybody understood and therefore was the gateway in to having a far deeper conversation. It's quite interesting that your stats seem to bear that out.
Yeah, you're right. I often say E stands for easy because it is much easier to understand that whole environmental piece. We can kind of see it, feel it and touch it. If and the S and the G are slightly more challenging for people to sometimes to kind of get their heads around. So I think what we're seeing is a real shift this year in terms of that balancing effect. So again, that's something that we can maybe pick up in the questions, or maybe pick up with Alex at the end of the session in terms of how we think about that in the context of portfolios.
Yep.
We ask every year also about business challenges for advisors. So it's always really interesting as they end one year and start another. What were the things that were concerning them? And I've often said that I could put money on this every year, that the top two challenges are regulation and PI cover. But actually what was really interesting for me over the last 2 years was, if you look at the survey for 2020, so the green bars, finding new clients was of a massive challenge and concern to advisors. And I guess if we think back to the timing of that, we were sort of in pandemic, clients were, advisors were finding it harder to engage face-to-face with clients, and potentially that was causing these challenges. And that's dropped right back down to only 10% in November. And the one that shifted in a different direction was all around succession planning and exit strategies that moved from 3% to 13%. Now again, we've thought about this long and hard, and is it because we're just seeing a huge amount of activity in this space? So we're seeing a lot of PE businesses out there paying interesting valuations, and is there a fear of missing out? Is it because everybody else is doing it, I need to look at what's happening in terms of my succession planning? Or was it actually that advisors as well, we often ask in the Fuller survey, are people thinking about retirement? And many advisors told us that their clients, because of the pandemic, were bringing retirement forward and kind of pressing the reset button and thinking about their lives. So potentially advisors were doing the same in regards to their business. And as a result, succession planning suddenly became a bit higher on their radar. And Philip, what's your kind of take on this one?
I think maybe the one factor that you might have missed out there is that every single practice principle is 1 year older than the year before, aren't they? So even if all other things remained the same, it would rise up the agenda. I mean, I think there's obviously so much activity in this space. I mean, it's impossible to pick up the trade press without seeing another deal, isn't it? And we've got 31 PE players and and at least half a dozen other non-PE related businesses out there, snapping firms up. So I think while it has that profile and while it has that activity going on, it's going to rise up people's agendas. I mean, I think it's quite an interesting area in total, because that covers a number of different things. That could be, am I setting myself up genuinely to keep the business running, and therefore it's about succession to run it as a going concern, or am I trying to plan to exit out and realise capital for myself, or or whatever. So I guess too, quite a bit of that statistic will be heavily dependent on who actually decided to answer at that particular cohort.
Yeah, absolutely. And we also wondered actually if it was a symptom of the fact that regulatory challenges and PI cover were absolutely out there as well. So had many advisors reached the point of that I'm going to think about exit. I don't know, Philip, does that resonate?
Yeah, I mean, I think if you really do buy into the margin squeeze hypothesis that many people are talking about, then it's clearly going to make sense for you to start to think about capitalizing now on the ongoing income streams that you have coming through. And I'm not even for one moment suggesting it would happen, but if the regulator decided that they wanted to price cap on, the price for ongoing services, for example, that could have a significantly detrimental effect to a number of businesses.
Absolutely. So again, kind of a number of different areas here that are of real interest to us as we monitor it year on year. And again, this will be an area that we cover in the next advisor survey. An area that was of real interest to me was also segmentation. I mean, we've talked a lot about segmentation over the last few years in the context of the PROD requirements, where advisors started to look at their segmentation and think about delivering appropriate products and services. Now, we've seen a real rise in this. So if you look at back in 2016, about 48% of advisors segmented their client base, and then that reached a peak in 2020 of 66%. Then we've seen this sudden dip down. So we wondered really what was actually causing that. And I guess I don't have all the answers, but maybe that's something that we could explore. But actually what was of, I think, probably greater interest was how advisors are actually segmenting the client bank. And we've seen this huge drop in advisors segmenting purely by clients' assets under management, which was often, if I look back to years ago, was a traditional way of segmenting client banks. And we've seen this corresponding rise in segmentation in terms of clients' life stage, which I've always thought feels like a more sensible approach to take, or maybe it's a kind of hybrid combination of the two. But I think the shift to client life stage was really interesting to observe. Philip, how does that fit with how you work within your own business?
We would be more the latter than the former. So I think I'd go even further than client life stage into thinking, which clients do you have that you know you're going to have an issue around cascading wealth through generations and want to deal more deeply with the family. You may very well have some clients for whom that's never going to be the case, and therefore the sorts of solutions that you're going to have, for a drawdown portfolio that is drawing down to zero is clearly very, very different to one where you think there's going to be a need to have some sort of inheritance built in. And they could be exactly the same life stage, but requiring very, very different things. So I think every single time this goes through a cycle, it's going to have a degree more sophistication in how you start to identify like groups of people.
Absolutely.
A very blunt tool to something far more sophisticated.
Yeah, it's almost like that later life segment has sub-segments within it in terms of how people behave. Yeah. But it was just really interesting for us to see the shift, because that was quite a stark change just within the space of a year. So again, another one for us to watch this year. As you know, I'm a stats geek. I love this kind of stuff, trying to work out what's going on. And Philip, you mentioned wealth transfer. Again, we ask about this every year just to see some of the patterns again that are emerging, and no big change here in terms of the number of advisors that are really viewing wealth transfer as an opportunity for their business. But maybe also interestingly is the numbers now that that still don't necessarily have a specific proposition for targeting transfer of wealth to that next generation. Despite the fact it's a big opportunity. So there's some interesting things again going on here. And one of the things we thought we'd do at this stage is just to have a little poll, which hopefully I think Andrew's going to bring up for me. We're going to ask, given that we're talking about transfer of wealth to the next generation, would you be prepared to advise a client with less than £50,000 to invest? So hopefully everybody that's on the call can just do this quick poll and we can see what the results are. I think you've just got about 20 seconds to get your vote in. We'll see what that looks like. Great. Andrew, are you able to share that? So that's really interesting that 67% of the people on the call would be prepared to advise a client with less than £50,000 to invest. If we look at what what the survey said, was something slightly different. If I can move this slide on. For some reason, my slides have got a little bit stuck. Here we go, apologies. So it felt to us like the stats weren't quite adding up in terms of, are we prepared to advise that next generation? So if we look at the advisor poll that we conducted, we've seen year on year, the number of clients, the percentage of advisors, prepared to advise clients with less than £50,000 has massively dropped, I think, down to 39% from 52%. So that was really, I guess, interesting and maybe challenging for us and different to the call. What we also saw was that the average client age was continuing to increase. So we ask advisors, typically for clients in different age segments, what does that look like? And we just saw that particularly age 51 to 64, the number of clients in that segment was increasing. So it felt to us that there was still typically a focus on richer and older clients. So again, some things for us to consider in terms of wealth transfer. Are we really making a change, and what does that look like? Philip, we've talked a lot about wealth transfer. What's your view on this kind of next generation client and where the advisor focus is?
So, I mean, maybe one point I would make is that the question asked specifically about, do you have a proposition? I think you could probably think about that more widely beyond just a proposition to a strategy.
Yeah.
And I think it does dovetail into what you want to do with your own business. I mean, if your own business isn't going to be around in 10 years' time, then there's going to be precious little point you engaging with the next generation if you don't think there's going to be anyone around to look after them and service them. But obviously for the majority of people that do want to realise some value, making sure that you can get some continuity of the assets that you currently have and continue to grow and expand with a younger client base in order to keep the thing moving is very, very important. So I think this, for me, this is much more about strategy than about pure proposition. And that is, how do you engage that next generation? Do you have the permission of the existing clients to bring them in? Because many clients don't want their families understanding the full picture at this stage in their, in their own planning. How do you do that? And actually, it's been one of the few things I think that's been of benefit over lockdown, because as we've continued to use remote ways of engaging with clients, it's far, far easier to bring people in different locations at a fixed point in time than it ever was when you tried to get them into the same place at the same time physically. So sure. It's how you can draw all of that together into a coherent strategy. And for us as a business, we know, every time reviews are coming around now with clients, it's a standard agenda item question. What do you want to happen? Do you or do you not want your potential inheritors to start to get involved in the planning process? If they are going to be trustees and things are going to be written in trust, they should understand what those obligations are. Can we help and support that? So there are a number of different ways of starting to widen that relationship up, and that's what underpins our strategy.
Yeah, exactly. And engagement, I guess, with that next generation doesn't necessarily mean having to advise them on a certain amount of assets. It's just making that connection. Yeah, so maybe that's why the numbers are showing the way they are.
Yeah, I would completely agree with that. I mean, I think you would answer the question very, very differently if it was the son or the daughter of somebody for whom you were looking after a considerable volume of assets and doing other work, who wanted to set up £150 a month savings plan. Your answer would be yes, wouldn't it?
Sure.
Whereas somebody coming in off the street, it may be very, very uneconomical for you to do that. So I think it's probably deeper than just a straight cut off to the level.
To the level, yeah. But certainly it's one that we're going to continue to look at. So when we asked about differentiated sales and marketing strategies for younger investors and also for women, because we talked a little bit in previous sessions about transfer to widows, we're still seeing kind of relatively low numbers, and particularly in the women and transfer to widows area. But you mentioned about, would advisors be prepared to do that if it was a family member? So we're going to just run another very quick poll, hopefully before we move to questions. So if we bring the poll up, would you be prepared to advise a client with less than 50,000 to invest if they were the relation of an existing client? So we'd just be interested to look at, does that actually then make a difference from bringing in new clients? So maybe if we could, and we've got yes, no, or maybe on this one. So if we just look at the responses on this one as they're coming through, it would be just interesting to see if having new clients but within the wider family would make a difference to that figure of £50,000. Yeah. So yeah, definitely. So there, Philip. So I think what we're seeing is that's definitely a difference in terms of how advisors would work. So we just close that down, and moving on just before we open up to questions. For some reason, the poll loves to stick my slides here. I do apologise. Here we go. So just before we move on to the Q&A, I just wanted to highlight, obviously, Schroders Investment Solutions. If you are thinking about looking for an outsourcing solution for clients in terms of model portfolios and multi-asset funds, then do feel free to speak to Alex or I or any of your local business development contacts about what we offer in this space. We run a full range of model portfolios at a 15 basis points management charge, and also correspondingly 2 ranges of multi-asset funds, full range of solutions to make sure that we can help you address appropriate client outcomes. And as I said, we're always happy to have a conversation with you about those. Our contact details, I'm sure you know how to get in touch with us all. So just as we move through these lovely risk considerations, I am going to say thank you very much for listening. I'm going to hand over now to Tom. He's going to chair the Q&A session.
Brilliant. Thank you very much, Gillian, Alex, and Philip, for that discussion. As Gillian said, it's time for the Q&A, so do feel free to put any question into the chat box, and I'll ask them as we go through the Q&A session. If you don't want your question to be seen by anyone else and you want me to ask it anonymously, just select my name from the drop-down menu and send the question across, and that way only I can see it, and I won't name you when I ask the question. But I'll kick us off. Alex, you started this the presentation with chat about sustainable investing, and so I'm kind of curious because exclusionary versus engagement has been a kind of big debate in the ESG sustainable space for a while now. We know which strategy is better, which one should you do, and I think with Russia and Ukraine and the war there recently, we've seen how effective exclusionary tactics can be, because it's collapsed, almost basically collapsed the Russian economy. Obviously, it's asset managers with the help of governments. But do you think that kind of demonstration recently has kind of destroyed the engagement debate, where people who favor engagement say, well, if you just exclude companies, someone else buys the asset cheaper and nothing changes? Do you think that's kind of blown that opinion out of the water somewhat?
I think it's been an interesting transition that we've seen, specifically for us. To move very much from sort of ethical exclusionary investing into engagement, sustainability, thematic, impact-driven outcomes. I think everyone is on the journey and understanding how the analysis is happening, and like you do with standard equity analysis and so on, understanding the ESG risks, country risks, geopolitical risks, events will clearly define frameworks and modify them as we go forward. I do think it's been a challenge for ESG investing, because you've seen this massive skyrocketing in commodity prices, and those that follow a more exclusionary type process has sort of been the net loser, if you like, off the back of that. That said, I think the trends remain the same for sort of decarbonization over the next sort of 10 to 15 years. That remains to be a trend, a theme that you want to pick up in your portfolios. Yes, that creates some short-term challenges, but I think that's where the engagement still plays. So it's about investing in these companies, making sure that you're engaging as a shareholder for them to change their sort of energy model going forward. And over time, you will be the net beneficiary of that. I think in the short time, like with anything, there'll be volatility that creates challenges for you in your portfolio construction, and this is just another one of those.
And Philip, how have you seen that? And is that kind of the Russia-Ukraine war, has that changed your opinions on engagement versus exclusion, or do you still see sustainable investing in ESG through the same lens that you did, say, 2 months ago?
Yeah, and broadly, I mean, I think we're a very, very broadly based business, and we took a decision that we wanted to embed ESG considerations into the way that we chose the funds that formed part of the portfolios, which are then pretty much standardly applied. I mean, I could count really on probably two hands the number of clients who ever come to us directly and raised that as a specific issue in terms of what they wanted to see happen. So that empirical change wouldn't be something that we would naturally react to in the way that some maybe more front-focused investment firms would.
Okay. And I've had a few questions come through to me through the chat box, so thank you for those. And someone's asked, they understand what's being said, but the FTSE 100 has held up very well, yet funds, whether more equity or bond-based, haven't. So post-Russian invasion, the drops have been less than pre-invasion, even though longer-term inflation has reared its head more recently. So I guess to you, Alex, do you have any views or comments on that funds aren't quite seeing the bounce that markets might be?
It is fascinating. So I'll start the answer by a comment, if I may. I mean, in the last 10 years, the FTSE has not been your friend, right, from an investment perspective. And at that point, it's about, Alex, why does your UK allocation not do as well as your US allocation? And then in 6 months, that's all changed. So basically, what's happened, right, is that you've got a very commodities heavy FTSE 100, right? And it is a handful of positions that has actually benefited off the back of that. And so there are very few asset managers that have been overweight or at index level when it comes to those sort of handful of positions that have outperformed in a FTSE 100 context, and therefore has been really challenging for them. Where a lot of financial managers or fund managers rather have been trying to take exposure, because if you think about the longer term trend that we've been seeing, interest rates are pressing up, we're moving into the sort of secular growth economy. At that point, you want to have exposure to financials because they'll be the net benefactor off the back of that. So a lot of these managers are sort of pivoting towards more financials. And during this sort of crisis, you've had net negative for financials. And the reason why is because, when Aeroflot stops making money, who's leasing those assets? It's the banks, and they're going to be the net losers off the back of that. And so banks sold off quite aggressively. Energy picked up, and I think that's created the perfect storm really for UK equity fund managers.
Okay. Anyone got any extra comments on that before we move on? No. So good answer from you, Alex, because you've kept Philip and Gillian quiet there.
He's the expert.
Yeah. Gillian, I'll come to you with the next one, because I see you mentioned prod and client segmentation in your slide, and prod's really interesting to me because it's kind of the forgotten about regulation in between MiFID, RDR, and all the rest that have come in, and SMCR in recent years. Yeah. I think on your graph it said that 50% of advisors or so said they segment clients. But do you think that's more about how advisor businesses articulate how they deal with the clients rather than actually segmenting them? Because I remember we had an IFA business owner in the last year or so write a column for us saying how he thought prod was a load of rubbish and that he doesn't do prod. And then he ended up by saying by the end of the column, actually, he segments clients in his own way. And isn't that kind of the point of prod anyway? It's not prescriptive. It's just about interpreting the regulation, being able to demonstrate it. So do you think there's kind of a lack of demonstration of how they're complying with prod rather than non-compliance generally?
Yeah, there's a number of points there, isn't there, Tom? First up, the prod regulation doesn't actually mention the segmentation word. No. I know we've always been really clear on that. However, if we're having to look at target market and deliver appropriate products and services, and it's interesting because initially when the regulation came out, we didn't think it applied to advisors until we read the detail. And interesting, the regulator calls advisors in the context of prod distributors, I think, which didn't feel right to us because we've moved away from distributing product, haven't we, to financial planning. So it didn't really sit with RDR, for example. However, that's another in debate. But you're absolutely right. We've seen a lot of advisors who've said, well, I don't want to feel like I'm too prescriptive, because clients still have to have individual suitability at the end of the day. So what we don't want to be doing is absolutely grouping clients and saying, for a client like you fit into this bucket here, and therefore the product and service for you is X, Y, and Z. So I think, obviously there's got to be a bit of fluidity around this, hasn't there? But also I think quite rightly at the end of the day, it's about what is the most appropriate outcome for the client, or what's the client seeking as an outcome, and what's the appropriate way to deliver that. And I think we just got to be careful that we don't necessarily put everybody simply into boxes. But I think you're right, the regulator was still expecting to see some kind of demonstration from advisors that they were kind of cognizant of the regulation and that they had something to demonstrate how they tackled it. And we do have a guide if anybody's interested in seeing that. We did that with our friends at the LANCAT. So if anybody does want our prod guide with some views on that, feel free to get in touch and we can make that available.
Yeah, Philip, would you agree with that? That it's more about demonstrating you're doing the right thing for your clients, and each client, whether they're segmented or not, in terms of just showing the FCA you are compliant if they come knocking.
Yeah, I mean, I think I completely agree with everything that Gillian's just said. I mean, I think if you end up with sort of predetermined buckets and triage at the front end and determine which bucket somebody's ending in before you even got as far as a KYC bit of activity, then you're clearly going about this the wrong way. I mean, probably the most obvious way that I can think that we're delivering to that on a day-to-day basis would be for things like the use of VCT or EIS or business property relief type products that would quite clearly be matched into the expectations of what people are trying to do with a plan, how important tax mitigation is, where the rest of the portfolio is, could they afford losses in an EIS product relative to stuff that they hold elsewhere. And that's where I think you can genuinely demonstrate that, we don't write a lot of that sort of business, but we'll have, 250 clients for whom that's entirely appropriate, and that's very segmented off. And I wouldn't dream of offering that proposition up to more mainstream clients.
And I know we didn't speak about it. I don't think we spoke about it specifically today, but how do you think consumer duty, because we're on the topic of regulation, so how is consumer duty going to change the environment for advisors?
I think for some firms it won't affect it at all, because it's always been central to the way that they've operated. So I think in common with quite a lot of this when it comes along, if the business isn't well run and hasn't put its client proposition front, left, and centre, then it's going to have trouble adjusting to it, isn't it? And if it does, it'll have less. So I think it's a bit of a trite answer, but you get my point, obviously.
Lovely. Alex, I'll come back to you this one. Someone's pinged across the question: does Europe's transition to a greener economy and more use of renewable energy offer fund managers good buying opportunities? So I guess is the outlook looking good in terms of that perspective?
It's a great question, and I think what this is again evidence is that the investment has not been there. And so over the last 10 years, the investment in green technology has not been sufficient enough to withstand these sorts of energy shocks. And we saw this pre-war as well, right? So last year when we saw a natural gas price spike because Russia sort of just tempted to switch off a bit of the taps, we knew we didn't have enough of this, right? Now the risk is that they completely shut this down. So I think, yes, from a fiscal perspective, governments are going to invest, corporates are therefore going to be beneficiaries off of this. In the short run, I think you've got to challenge that a lot of the investable opportunities have run a long way. And so you've seen a massive flight into, let's call it clean energy, if you like, and that has really stretched valuations. So I think in the real short run, I think you've got a bit of a challenge there from a portfolio construction capability, but the long-term trend is absolutely clear that decarbonisation is happening, investment will be made, and there will be clear beneficiaries off the back of this.
Without getting too political, do you think Western European governments will invest enough to aid that transition, to make it, to probably aid the transition, but also make it an attractive enough investment for markets?
I suppose it leans back to, do you think that sort of populism comes back by popular demand, right? Because there is this sort of social consciousness that's driving disruption, not only in private business, but in pre-election times as well. And so I think we as a collective have a much stronger voice and are being listened to a lot more in a post-COVID world than we did before. So I think, yes, you've got a bit of deglobalization happening, and at the same time, you probably have the rise of populism again as we sort of move out of pandemic era. And I think that pressure would put leaders at bay to start investing in that. We've already seen sort of fiscal stimulus coming off the back in order to invest here. It's just, does it keep coming, I suppose, is the question.
And kind of adding on to that, do you think we're past the point where people still believe you need to sacrifice investment returns if you're investing in ESG sustainability thematic, or do you think generally people accept that you don't really have to sacrifice anything for doing good, or do you think it is the case?
I think there's a mixed bag on that one, and it would be good to get sort of Philip's view. The conversations that I've been having is around, yes, we acknowledge that without integrating ESG, understanding the risks that business models could face going forward, that we're going to be in a worse situation, right? It's like analyzing expected costs or infrastructure investment. That is part of your model. The other one is now, what are the decarbonization risks? How does climate change affect your business model? How do certain social aspects, diversity, all of that investment, you have to count that into how you determine the value of a company today. So I think that is a given. I think there is definitely some skepticism by investors still to say, well, if I'm already investing in what is the best businesses today, surely the upside must be less going forward. And I think that's probably where we need to be a little bit more clear in saying, we're not just investing in that, it's about investing for change. And that comes back to your first question around sort of the engagement story going forward, because that's probably where the delta sits rather than sort of exclusions.
Yeah, I mean, this is slightly above my pay grade, but I completely agree with that. I mean, I just don't think you can say with any certainty that there's an obvious financial sacrifice in going down that route. It could be a consumer-related firm whose customer base is under the age of 35, who responds considerably fantastically to the changes being made in the company, and it starts to drive more profit from it. So, so for every cigarette arms manufacturer that I could argue you might be losing cash, you could find examples where you could construct a hypothesis that the company would do better than it currently does, and probably I suspect you'll end up with are leveling out across the pieces, it becomes more and more the norm. So I think too, the other point I would make is that with younger clients, I think there's a natural assumption that the trading off of return is a price that nobody's prepared to pay. Well, notwithstanding the fact that younger cohorts have less money to invest and are more cash strapped, I think anecdotally you do see that they will be more susceptible to being prepared to pay that price if that's the price which needs to be paid. So I think there's a myriad of different things that are going to start to affect how this plays out, I think.
Cool. We've got about 5 more minutes for the Q&A to keep the questions coming in. But Alex, I'll kind of continue down that theme and ask that, do sustainable or impact investments, that kind of investment strategy, does it lean itself more towards growth investing because they're technological companies rather than value investing? Does it kind of end up that way?
I think it has in the last sort of 18 months, really. I think if you think about the COVID scenario and what stocks were in favor there, it was, your stay-at-home stock, Zoom, Microsoft, Amazon, etc. And it's easier for those companies to adopt sort of decarbonization. It's much harder for sort of banks to pivot financing models. It's much harder for oil and gas companies to generate different sources of revenue. And so those are value companies, these are growth companies. And so you can understand how the construct has happened. That said, though, I think we've come a long way as well. And so if you start looking at some of the funds, because as you know, Tom, we look at all funds. So we're best of breed managers. It's not just Schroder funds. And so if you start looking across the board, you can see there are more sort of value orientated strategies that are looking to invest in companies like Shell, as an example, investing in E10 fuel, saying through engagement, what is your decarbonized strategy? How are you reducing emissions through your sort of jet fuel and all things like that? And investment in infrastructure there and technology. So yes, I agree. I'd say in the last sort of 18 months, that holds true. I think going forward, it's going to be up to us as sort of discretionary managers to go and find the opportunities where you have a more balanced approach.
Okay. It's an interesting answer. Gillian?
Well, I was just going to add to that, Tom. I mean, one of the things that's really crucial for us, particularly running the model portfolios, is that that we have really good quality reporting for advisors to use with clients to demonstrate not just obviously the financial performance, but also the positive impact that investing in these portfolios can give. We do things like report against the UN SDGs, but also, using our own tools, we can give investors a really good picture of the positive impact that they're giving towards people and planet. And I think equally that's becoming more and more important to clients as well. Prove what you're doing, if that makes sense. And I think that's, as we go into this year for us, that's something we want to continue to improve, but also to help educate across things like net zero. What does that mean? How can we explain that really simply to clients? So again, we've got a lot of work in pipeline to continue that dialogue with both advisors and their clients.
Yeah, I suppose that's quite important because people have a lot of preconceived ideas from whatever media they read. And, I would expect these investments to be more growth stocks because generally you read about the exciting up and coming investments that are, might change the world or save something. So yeah, I think educating clients is particularly important in this area for sure.
It does seem to me that it does have the opportunity to get people far more engaged in how their money is actually working for them. I mean, putting out stock stories is not exactly new, but it's still pretty tangential when you're buying a fund, and it's not like you're tracking it through, but you can actually make this stuff come much, much more alive, I think, in clients' eyes than we could have historically, because they bought into the basic premise of why it's been held in the first place.
Cool. We've got about 2 minutes left, so I'll throw one more question over to you, Gillian and Philip. So in terms of advising the next generation and practically putting an advisor firm putting a plan in place to do so, do you think it's important they need to write down, have a bona fide plan of this is how I will advise younger clients, perhaps with less assets, or can you just start bringing in families without a real long-term plan, or do you really need to kind of secure a strategy for 5-10 years of how you will serve them profitably in the future? Is there a balance?
Yeah, there's a bit of both going on here. I mean, I often talk about, you start with doing an audit. Do you actually have a challenge within your business? And what would it look like if all of your clients are in that later life segment and there's no transition or retention? I'm going to stop calling it the Great Wealth Transfer. It's actually the Great Wealth Retention Strategy, isn't it? So it's about, from a planning perspective, you could start by looking at, do I have a problem here? Am I engaging? And if you are, great, and if not, then what would that look like for the future? The impact on my business. So do I need to future-proof my business a bit more? And therefore, what can I do? And then the next step is really about thinking about what would a proposition for that next generation look like? Is it simple, just a contact strategy? Is it involving them in the family conversations? And we've heard time and time again how that can at times be difficult. But can I put, maybe some technology around this and deliver a light touch, low cost solution for those clients? And we hear lots of great examples of that. Can we engage by talking about wills and trusts and power of attorney? It's almost like just being in front of that next generation clients, but also don't ignore the fact that many of them are now hitting that top end of the millennials. They're not teenagers. That we refer to them often as children, and do you know what? They're not. And many of them are looking at saving for pension or mortgage advice. And so we really think that just by sitting down and working it all through, advisors can start to put strategies in place to engage that next generation.
What about you, Philip? Just want to finish off there. Sorry.
Yeah, I mean, I completely agree with that. I mean, you write any plan you like, but step one is build a relationship. If you haven't got a relationship, then it's going to be pretty transient in the first place. So it is, we've had a particular focus on making sure, as part of a tax efficient sweep up, at review time, that junior pension, junior ISA type money is coming in, and that we can start to communicate out how that's doing to genuinely to children, Gillian, actually, kind of going against your point, to start to build that relationship and get our name to the forefront, even though it's not been their money that's financed it in the first place. And we've got quite a lot of work as a business to start to think, well, great, but what's the next stage? How are we going to move as they start to approach to being 18 or 21? And, should we be talking to them about getting appropriate finances as they go through university and coming out with mountains of debt? Well, yes, we should. It's just a question of getting that planned and programmed and done. But our step one has always been start to build the relationship first of all, and hopefully the rest will come.
Brilliant. Well, that's all we have time for today. So thank you, Gillian, Alex, and Philip. That was a fascinating discussion. So thank you for your insights, and I think that was a pretty lively Q&A session in the end. Now, before we wrap up, let's just take a quick look at those learning objectives again. There we go. They're beautifully popped up on screen. So the presentation has covered an understanding of the views on the investment market in November 2021 and how they've changed now. We've discussed the importance of ESG factors when selecting funds, client views on sustainable investing, and some of the challenges with proposed legislation, and help you assess your business in the context of the wealth transfer or retention, as Julian said, the opportunities, difficulties, and potential impact on succession planning. As I said, that's all we have time for today. So thank you for your questions, and thank you again, Gillian, Alex, and Philip, for joining me today, and for letting me and the folks at home grill you with all of our questions. On that note, I think a couple of questions didn't get answered, so Gillian and the Schroders team will do their best to do so after the event. And before we close up, I should assure you that your CPD will be delivered tomorrow. And before we sign off, let me quickly remind you of some dates for your diary over the next couple of months. On the evening of the 26th of April, we'll be running our annual Professional Advisor Awards. We'll celebrate the very best in the business at a glittering event at the brewery. The very next day, 27th of April, we're back at the same venue, the brewery in London, for the UK's largest annual management conference for advisors, PA 360. This year, as every year, we'll have a packed and varied programme with more than 40 speakers covering every aspect of running an advisor business. We'll start the day with a power panel where the CEOs of Fintel, Tenet, True Potential, and Sesame Bancorp Group will give us their view from the top in what is set to be a challenging year. Our keynote speaker this year, in this Commonwealth Games year, of course, is none other than double Olympic gold medalist Lord Sebastian Coe, who also brought the Olympics to London in 2012 and was an MP in the 90s. Seb will be offering some insight on how to incorporate the disciplines of elite sport into effectively running a business. If you're in the north and can't make it down, don't worry. We'll be bringing you our annual PA360 North Conference in October. And finally, on the 4th of May, we're back to working lunches again with Baillie Gifford. There's been a great deal of talk over the past months about US equities being expensive. So we'll be joined by Baillie Gifford's US equity investment specialist, Ben James, who will tell us Baillie Gifford's view on the world's largest market and where they see opportunities for growth. All in all, that's a total of 7 hours CPD for you. So keep coming back to Professional Advisor for great journalism and great events. So that's it for today's session. Thank you again to all our speakers, but of course to you, our readers, for your company this lunchtime. I trust you found this helpful and worthwhile. And if you did, then we'll look forward to seeing you again at many of our events coming up soon. Goodbye.